Hello, and welcome to the Money Magnet Learning Series, Module 2, Make More Money. Simple truths to boost your bottom line. My name's Jennifer Wallace, and I'm an independent insurance and investment advisor with Jennifer Wallace Insurance and Financial Solutions. A reminder that all the information is based on Canadian legislation, so if you're watching from a different country, please consult a qualified advisor in your area for help. The learning series is designed so that you can go through each module in order from beginning to end, or simply select the topics that are relevant to you. Let's get started. In this module, we're going to be talking about money that is being thrown away that you may not even know. We're also going to look at saving versus debt, funding large purchases the smart way, as well as examining the good and the bad of interest. Did you know that money is being thrown away and you don't even realize it? You are taking money and it's disappearing because you have had perhaps difficulty paying a bill and are incurring a late payment fee, or you have a high interest rate on a credit card and you're having interest occur every single month that doesn't need to be. There are a few ways that you could be unknowingly transferring money away from you and not even realize what kind of money it is that's leaving your pocket. Let's complete the following exercise. Grab a pen and a piece of paper, collect your most recent full months of statements, so that's your bank statement, credit card statements, and calculate the total amount that you have paid in fees, in interest on credit card statements, as well as any other bad debt. So that's lines of credit, anything that has a high interest rate, that you are having a balance carry forward from month to month. Now, look back at any bills that you've incurred late payment fees and include those fees as well. Tally that all up. What's your final number? That final number is money that you could be putting back in your pocket just by making some financial changes. In fact, $8,500 is the average Canadian's non-mortgage debt that they're paying interest on to carry from month to month. With interest rates like 19 and 29%, that $8,500 can really rack up the extra fees and interest without you even realizing how much is actually costing you to service your debt. Canada is one of the most taxed countries in the world. Now, with those taxes, we certainly have a lot of benefits. But tax is one of the most common ways that money is being transferred away from us without us not even really knowing. There's a lot of misconceptions when it comes to tax and income tax and deductions. So let's kind of just talk a little bit about that here. You could be potentially saving money just through a deeper understanding of how tax deductions can be taken advantage of and which ones are available to you. So let's look, do you have your income tax return professionally completed and reviewed every year? If so, do you talk to your tax preparer about the different deductions that may be available to you? Oftentimes, a tax preparer is simply preparing your return based on what you provide to them. The onus is then on you to know tax legislation and know which deductions you would be eligible for. Take the time, invest in the professional fee that you may be charged to sit down with your tax preparer to really fully understand, because once you know, you could be losing hundreds of dollars of possible deductions by just not knowing that you're even eligible for it. Keep your receipts. Know what eligible deductions are available to you. Do you keep all of your original receipts or just the ones that you happen to come across come tax time? Get a system in place so that your receipts are kept in a safe place and you know where they are at all times. That makes both your life as well as the life of your accountant much easier come tax time. Lastly, do you make sure to pay your income tax owing if there is any amount owing, right away so that you don't incur late payments and penalties. If you know that traditionally or historically you will have an income tax amount owing at the end of the year, it's wise to be able to put a little bit of money away so that you can pay that off right away as soon as you know what that amount is. Oftentimes, people will ask their employer to take a little extra off of their paycheck. That's wise if you know how much you're going to have to pay, because that way you're actually paying that throughout the year directly to the government, instead of the temptation of that being in a savings account for you to have easy access to. The only thing with that is that if you're not sure how much money you're going to actually owe them come the end of the tax season, you may be better off just giving your normal remittances and having that savings account so that the government isn't being kind enough holding your money for you without actually giving you interest on it if you do get a tax return at the end of it, so a tax refund. Each annual budget that is produced for Canadians by the federal government changes what eligible deductions are available. So I would not expect a normal person to know exactly what eligible deductions are available to them. That's for your tax preparer. So make sure that you are in contact with them and take the time to know what changes might be applicable to you. I also produce a blog post with every single budget that is released that kind of outlines for the average family any changes or any new or reduced deductions that might be available. So doing a little bit of research, if you'd rather not go in and talk to a tax preparer, is also available to you. Please feel free, wallace-solutions.com, to my blog, and find all that information out every single year. The average Canadian's income tax rate is 42.5%. That's a lot of your income to be giving away, even though we do have a lot of benefits here in Canada. So definitely being really active and participating in your income tax return preparation can end up saving you a lot of money. That's money being transferred away from you that you had no idea about potentially. Let's talk about saving versus debt. So a lot of people, we live in a wonderful world now where immediate gratification is the name of the game. So someone would rather buy something on debt than save their money and have to wait until that money is saved in order to buy that large purchase or even a small purchase. Sometimes it's that $300 item that they'd rather go and buy on credit than actually save for a couple of months to purchase. It's important to really look at what you're spending for debt and what you're spending for savings. So if you are inclined to build a savings pot, then do that and consistently make it a habit to pay yourself first and really put money aside into that saving, because it's then available for you for emergencies, for large purchases, or for other expenses that might come up. The value of investing in you is that it helps your financial well-being and should be a habit that you start basically from the first time you get a job. We're going to be discussing in Module 4 some mechanisms for saving and investing, but it's building the habit that is certainly the most important thing. Your ideal emergency fund will have about 3 months of your average monthly expenses, at least. That's a conservative amount. Now, most Canadians do not have 3 months of their average monthly expenses, because if you look at an average household maybe has a total monthly expenses of $3,000 to $4,000, that would mean they've got about $10,000 or $12,000 saved in an emergency fund. That's just not realistic for a lot of people. They'd rather have a credit card that they could use as an emergency fund. However, they would be incurring interest, and potentially, if something were to happen where, for example, you need an emergency fund to be able to pay your living expenses because of a loss of a job or an illness or an injury that prevents you from being able to work, you're now racking up debt and not having an actual income to pay that debt down at all. So it can be very dangerous and again can negatively affect your credit big time because you don't know when you're going to be able to significantly reduce that amount of debt that you're incurring. So definitely take a look at what you're going to be allocating to debt and what you're going to be allocating to savings. Make sure you're putting something towards your savings account every single month. Savings can help with everything from being without an income to having additional medical, dental, other unexpected expenses such as car repairs or home repairs, needing a new furnace. You're then not having to resort to either getting some high interest debt because you need something in a quick jam to get you out of that situation. And it's also having a savings account will give you that availability for cash flow should an opportunity arise. So let's say there's an opportunity to invest in something that you wouldn't want to really be taking debt to do that. Your savings account will be able to be readily available for such an opportunity like that. And in fact, 32% of Canadians have less than $10,000 in savings. That's in 2015. Now, with the increase in interest rates and the amount of debt that Canadians are currently carrying, I bet that has actually reduced since 2015. So most Canadians are saying that because of their income level being low, that is a barrier for them to save. So again, it's really just about creating the habit and putting something away, even if it's $20 a month, to be able to put that in. It does rack up over time, believe me. When you're looking at funding larger purchases, and we're talking like something more like an appliance or a vehicle or something like that, there isn't really a golden rule of is it better to finance it or pay cash for it. I always like to tell people, look at what the actual item is and make the decision then. I mean, you've got some smaller purchases like if you're going and buying a dishwasher. That should not be something that's financed because it's really not worth it. Any furniture, electronics, same with any like a cell phone or anything like that, they are big ticket items for a lot of people. But if you're going to be financing them using an interest-bearing credit card, the interest that you could end up paying could really significantly increase your overall cost for that item. And is it really worth it when you've got an item that's actually a depreciating value? As soon as you purchase it, it goes down in value. So for you to have to pay more than what the actual ticket price is isn't really worth it. When you're looking at purchases over $10,000, for example, odds are you don't have that amount of money in cash or that you would be comfortable releasing for that purchase. So a lot of people do not walk in and pay $40,000 cash for a vehicle. It's either, even if they have it, it's just not within their ability to drain their savings account. So this is where financing is a viable option because not only is there an asset that's going to be attached to that loan to secure it, but the asset is something that is of use and has a greater purpose than just an electronic item. So that vehicle could be your way to get to work every day that allows you to earn an income. So you want to be taking all that into account when you're making a decision on funding a large purchase through financing or paying cash. I want to caution you here on, again, using credit to fund a large purchase or that smaller purchase like an appliance through a retail store credit card. So this is something that a lot of people can be so tempted because they walk into the store and it says 0% interest as long as you pay for that entire purchase within 12 months or whatever those payment terms might be. Be really careful with that because you know what your current financial situation is. You do not know what it will be in 12 months. So this I've seen time and time again where that 12-month period comes and that bill isn't paid in full. Suddenly there's a whole whack of interest that's attached to that because something happened, life happens, and things come up. And a year is a long time to be able to spread that purchase over for sure, so you can pay in small increments, but that might also come back to bite you. So be really careful about the choices that you're making with funding smaller or larger purchases for sure. And even just looking at what your average credit card interest rate is, 19.9%, that's a conservative one. If you've got super duper credit, you might get something lower around the 12% mark. But anywhere from 19.9 to 29.9 or even higher is an average Canadian credit card interest rate. So if you're deciding to only use credit to purchase items, then you're paying a significant percentage, 20% or more for that particular item. And is it really worth it? Would you buy that appliance if it was actually the ticket price was 20% more than what it is? Probably not. And moving into what interest rates are, there's good and there's bad interest rates. So, and it's not just an interest rate, what the number is, it's what interest you're paying or what interest you're earning. So let's just talk a little bit about interest, because that's a word that gets tossed around and can mean so many different things. So let's start with the interest that we have to pay. So we know interest is the rate at which we borrow money. So interest rates are determined by the Bank of Canada in Canada. So the Bank of Canada lends money to other banks and lenders, including credit card companies. So those banks and lenders and credit card companies set their prime interest rate based on the Bank of Canada's overnight lending interest rate. So that is the rate that it costs the bank to borrow from the Bank of Canada, which is essentially like the Treasury, right? So they have all the money, the banks borrow the money and then lend to you. So the bank is basically similar to a wholesaler, where they're just going to mark up what they're lending to their retail customers. So if we're coming out of an extended 0% interest rate environment, which we are, we have seen over the last couple of years, the Bank of Canada has increased its prime lending rate from 0%. It's now 1.75% as of December 2018. And we will definitely see further increases of that as the Canadian economy grows stronger. So with that increase, the banks are then forced to increase their prime lending rate to us, to the consumers. So we're seeing across the board everything from loan rates to mortgage rates to even credit card rates are being increased. If somebody had a really great line of credit or credit card rate, odds are they've gotten a notice that says we have to bump this up because everything else has gone up too. So beware, we're seeing a lot of people have racked up a lot of interest, a lot of debt in a low interest rate environment. So it's very tempting because you can be getting things super cheap in terms of their interest rate that's being offered by a bank. You're getting a mortgage at 2%, 2.5%. Now that everything's going up, all of those expenses are now going up, right? So if you've got a mortgage rate at 2.5 that's now up to 2.8, your mortgage payment each month has increased. Your debt hasn't gone down, but now you're paying more to service that debt. So be very cautious. We've seen a lot of Canadians over this low interest rate environment phase really increase their consumer debt because they've wanted to spur the economy, which is fantastic. So they're spending with either a line of credit to do some renovations on their home, or they're shopping using credit cards, all of those interest bearing lending vehicles. And it ends up that, that interest, that prime interest lending rate was 2.5% has now gone up to 3.95%. So they are now caught in a bit of a jam. And that's really something that, as a Canadian, that might be exactly what you've experienced as well. So definitely beware of the temptation to borrow just because it's cheap, because it's not always going to be cheap, right? Now, moving on to the good side of interest. So this is the interest that we make when we invest money, when we put money into savings, when we're doing something with it that's effective, and really kind of looking at how our money can work for us. When your money works for you, that payment to you, that gain, is interest. So, unfortunately, with a low interest rate environment, it also diminishes investment returns on things like a guaranteed investment contract, or GIC, or bond investments. So, a bond is when you're buying a corporation or a government's debt. So if they're borrowing at a cheap rate, then you're not going to be paid a lot because it's a lower interest rate that they're borrowing at, right? So you want to kind of stay away from a lot of those vehicles in a low interest rate environment because they're just not worthwhile for you to invest in. Talking to a professional advisor can also help you to navigate what that looks like and where you should be putting your money in order to get a great return with your portfolio, and understanding your risk. So we're going to talk about a little bit more of that in Module 4. When you're looking to allocate your money for either investing or paying down debt, keep in mind what those interest rates are. I have had clients many times just come to me and say, I've got a bit of a windfall. It might be an inheritance. It might be an income tax return refund. And they say, I've got this money. What should I do? Should I put it down on my mortgage, or should I invest it? So my rule of thumb always is, what's the better return? If your mortgage, especially in this low interest rate environment, is only costing you 4% or less, and your investment portfolio is earning an average of about 7% net of any fees, you're smarter to be investing that money and making an extra 3% than paying down your mortgage, because that's not really going to get you any short-term gain. It might, if you're refinancing, lower your payment slightly each month. But even then, in the long term, 10 years down, you'd be better off earning 3% additional money on what your investment's doing, because that's compounding for you, right? So 5%, just as a little add-on, is the average Canadian 30-year fixed term mortgage interest rate available. That's obviously dependent on a credit and the institution that you're banking with. But just to give you an idea, a lot of portfolios are earning a lot more than 5% on average in the last few years. So keep in mind what that interest rate differential is, because that will help you to make a really informed and smart choice. Moving on to your next steps. So we've calculated your fees and your penalties. We've kind of seen where exactly all your money is disappearing to. Whether you've known that it's disappearing or not, we've been able to put a solid number beside that. We've also taken a look at what your savings plan is, and hopefully you've gained a better understanding on what debt is like and what the interest rate environment is like, so that you can continue on making some great informed decisions as we move to Module 3. Again, if you do have any questions for me, please email me at jen with 2 n's at wallace-solutions.com, and I'd be happy to either give some help with calculating your fees and penalties, or helping you to review your savings plan, as well as answer any questions that you might have come up. Thank you for sharing Module 2 with me, and I look forward to chatting with you further in Module 3.